Welcome to the Sunday paper. On Friday, Jerome Powell, the chairman of the Federal Reserve, stood at a podium in Jackson Hole, Wyoming, and said, 4.5 years after COVID 19's arrival, the worst of the pandemic related economic distortions are fading. Inflation has declined significantly. The labor market is no longer overheated, and conditions are now less tight than those that prevailed before the pandemic. This was his magnum opus. The stock market slid into a recession in March 2020 on the heels of COVID lockdowns across the world. In response to this, the U.S. Federal Reserve immediately cut interest rates from 2.16% in 2019 to 0.04% in 2020 and 0.08% in 2021. At the same time, the U.S. government issued stimulus checks to citizens. Trade saw a massive backlog with supply chain issues, and we saw commodity shocks in corn, wheat, oil, lumber, and livestock. With the cost to borrow money so low, supply inventories low, and commodity shocks across the world, we experienced a massive spike in inflation. From May 2021 to March 2023, the Consumer Price Index increased no less than 5% per month and was at 9.1% at its peak in June 2022. Everyone thought the Fed was losing their grip on the economy. In response to this sharp increase in prices, the Fed did the one thing they could do. They started raising interest rates. In March 2022, the Fed began the process of raising interest rates and took us from 0.2% to a peak of 5.33% in August 2023, and they've kept them there to this day. As a result, we saw a decrease in home sales and a slow increase in the unemployment rate. We also saw the collapse of regional banks. Banks borrow long and lend short. And since banks locked in long-term bonds at a sub 5% interest rate for seemingly the next decade, but had to pay 5+% interest for the foreseeable future, banks like Silicon Valley Bank and Signature Bank closed their doors for good. Other banks like New York Community Bank experienced deep losses on their books. KRE, an ETF that tracks regional banks on the stock market, peaked in January 2022 at $78.81 a share. Since then, it is yet to break through $60 a share. Now that the Fed has decided to progressively cut interest rates, the first thing I'm looking at are bonds. It could be a good idea to lock in bond rates now while they're still in the 3s and 4s. Banks borrow long and lend short, so they too will be buying bonds to lock in higher rates and do their due diligence to lend at lower rates. That could provide stability to the financial sector, meaning ETFs like KRE and XLF may be worth watching. The market has also been pre-positioning for what they've been calling breadth thrust, or in other words, the new economic environment could be a great opportunity for many businesses. Small businesses can borrow money at a lower rate than they've been doing over the last few years, so that could be a tailwind for the Russell 2000. Individuals can also borrow money at lower rates. That's good for small direct-to-consumer focused businesses. The small caps index closed the gap created by the carry trade fiasco earlier this month. Now we're standing by to see if it can recapture its previous high of 228.63. Exogenous events could always set the market back a couple months. The carry trade is still brewing below the surface now that the US is cutting interest rates while Japan is raising rates. And the stock market doesn't go in a straight line directionally. But now that we're in the next half of the interest rate cycle, we could be experiencing the beginning of a 3 to 5 year growth period. Next week, I'll be watching to see what happens with Nvidia after hours on Wednesday when they report earnings. The expectation is for them to report $28 billion in earnings for the quarter, with some analysts looking for anywhere from $30 to $34 billion. A beat on earnings would be a good sign for the AI growth story, and an increase in forward projections could be the catalyst the market needs to retest and even break out of the all-time high of 565.16. But I'll also be keeping an eye on the 50-day moving average. We saw it last Thursday. We could see it again as the market prepares itself for the fourth quarter of 2024.